And Adcock, of course, also coming out with their trading update today, expecting full-year headline earnings per share to be between 17 and 18% lower than 2012. Now, the pharmaceuticals business received a firm offer from Chilean pharmaceutical firm CFR on Friday to acquire the company for 12.6 billion rand. A shareholder has filed a complaint with the JSE accusing the drug makers board of misleading investors over support for the bid. Meanwhile, Netcare yesterday reporting a 25% rise in full-year profit, helped by a strong performance in its home market. Here to unpack the healthcare sector now, Alec Abrahams, a healthcare analyst at AfriFocus. Alec, thanks for joining us today. I'm going to start off with Netcare because, it's an interesting story in terms of what's happened in the UK, how that market has been impacted, of course, by the financial crisis and the downturn in that economy, and how that's impacted essentially their investment. Looking at BMI, I mean, this was the biggest private hospital group and still is in the UK. They bought into it at a good time and things have changed dramatically. How's that impacted their earnings there?
Well, what that's done is it's put a lot of pressure on their margins. When they bought the business, 97% of the patients were private paying patients or patients with private medical insurance. And those tend to be a lot higher margin than national health patients. Obviously, with the pressure in Europe and the pressure on consumer spending and the downturn that we saw there, a lot of the Brits turned away from private medical insurance because the reality is the national health system is an adequately good system for their medical needs. So what that's meant is that the structure of the patient mix has moved from high margin private patients to lower margin NHS patients.
Richard Friedland says this is a structural shift. I mean, does that mean that you could start talking about an ill-timed investment going forward?
I don't think ill-timed. I think it was still a good thinking. The reality is, if you look at the time that Netcare made the acquisition, the trends were not only in the UK but throughout Europe a great moving trend towards private health insurance, because the reality is European populations are getting older. They require a lot more in terms of healthcare, and the tax basis to support that healthcare system is not being adequately funded from the small tax base. So the reality is it can't last. It's not sustainable. So the trend towards private health insurance was a definite trend. The reality, as I mentioned, though, is that with the downturn and with the pressure on consumer spending, the healthcare systems in those social economies are still quite strong, and you have seen a temporary shift to national health again. But the reality is you will see more pressure on the governments to fund those national health systems, and you will see a greater incidence of private health insurance, which will obviously come through.
Looking at the overall balance sheet now of Netcare, I mean, they've got full-year net debt, or net debt of the group, which is reduced from just over 26 billion rand to around 4.8 billion, 4.9 billion rand essentially. I mean, that's a massive reduction. It relates to the deconsolidation of the property group.
Yes.
Are there still risks in the business? I mean, is there still a massive debt overhang that they need to deal with? How do you see them reducing debt further?
Yes, there is a risk in the business. The reality is arguably the value of the properties that are held as security against that debt may not necessarily actually make up the value of the debt. And what we see in the case of Mediclinic, for instance, where they also had to refinance their debt, the value of the properties were in fact higher than the debt outstanding. So they were able to get a very favourable renegotiation of the rates, and they managed to halve the interest rate that they pay on that debt. In the case of Netcare, not as simple. So yes, there certainly is still a risk around the renegotiation of that and the restructuring of that debt.
I mean, you mentioned Mediclinic, and of course we've also got Life Healthcare in South Africa. Of the three hospital groups, I mean, which do you see as best positioned for growth, specifically if we're looking at it from a stock perspective right now?
I personally like Life Healthcare at the moment. I think they're looking very strong in South Africa. Life Healthcare is the pick of the litter in terms of margins. They've got a higher sort of proportion of medical cases than surgical cases, medical cases being higher margin. They're also a very efficient organisation and are focused on improving efficiencies. So
but aren't they all? I mean, Richard Friedland also talks about the massive drive to improve efficiencies.
They are all, because they have to.
Yeah.
In the case of Life Healthcare, I think to some extent they're putting their money where their mouth is. A large portion of their payment comes in the form of alternative reimbursive payment models. And effectively what that means is that the risk of the cost of the healthcare is being shifted from the medical funder to the provider. And I think rightly so, because the provider is the best at managing that cost. And I think the medical aids like the fact that that risk is being shifted, and I think that's why Life Healthcare is a favourite among the medical funders.
There's also a drive to focus on psychiatric care, mental health care. Is that something that could boost Life Healthcare's earnings going forward? I mean, what do you think of that strategy specifically?
I do think so. The medical or the mental health facilities, what they do is on a group basis, they increase the proportion of medical cases versus lower margin surgical cases. So from that point of view, as they grow that side of the business, I believe it definitely enhances their margin going forward.
Let's move on to Adcock. And of course, there's lots going on with Adcock. And on Friday, I asked Adcock Chairman Kotso Makele why the deal would benefit shareholders and getting support from the PIC.
The PIC is a major shareholder, is the biggest shareholder in both in direct holding and in beneficial terms. And certainly, we as the independent board would want to see the PIC on board, and we're going to be working very hard with the PIC to make sure that we can find each other, and that the PIC in the end will be supportive of this transaction, so which is really a good transaction for the company and for the country. Complementarity, synergies, which are not even included in the price, revenue synergies, cost synergies, and the complementary portfolio of drugs and geographical diversification.
It seems, the board of Adcock really trying to push for this deal to go ahead. That's what you get a sense from the type of comments they're making. Mm-hmm. How did Adcock get into position, in your view, having analysed the healthcare sector for some time, that it actually eventually became a takeover target?
The reality is, before it was taken out by Tiger Brands many years ago, Adcock was the biggest player in the market, and the market dynamics certainly supported the business. Unfortunately, in the ensuing years, while Adcock was being housed in Tiger Brands, I believe that the market dynamics had certainly changed. There was more emphasis on generics, for instance, and the big difference being also that before Adcock was negotiating and
I've just got to jump in here quickly because the market's closed in South Africa down 0.9%, 11 points over 45,000 on the day. We'll get into that after the break. Sorry, continue on Adcock.
Yes, so as I mentioned, previously Adcock was supplying a fragmented retail pharmacy base where they had definitely the upper hand. They had a broad range of products that they were supplying to those independent pharmacists. In the ensuing years, we've had the corporatization of pharmacy ownership, and right now Adcock is negotiating with very, very strong corporate groups, particularly Clicks and Dis-Chem, and that obviously changes the negotiating power that they have.
We've got to wrap this up. The world has changed for Adcock essentially. Does this deal make sense?
Yes, this deal certainly makes sense. It brings two very important components into the Adcock business model that aren't there, and that is exposure to growth markets, also diversification from the South African market, and it also gives them greater exposure to generics.